Thank you very much, everybody. I'd like to call today's meeting to order of the Public Accounts Committee. And with us today is Nancy McNeil-Smith, who is the Superintendent of Pensions. So we'll have the next 2 hours to explore that issue. And I'd like to begin with having the members of the committee introduce themselves, beginning with Mr. Smith.
Thank you. Morris Smith, MLA for Antigonish.
Gordy Goss, MLA for Cape Breton-Nova, filling in for the young and talented Matt Wynot today.
Well spoken.
Clary McKinnon, MLA Pictou East.
Leonard Pereira, MLA Halifax Citadel, Sable Island.
Keith Caldwell, MLA Preston.
Alan McMaster, MLA for Inverness.
Chuck Porter, MLA for Hants West.
Diana Whalen, I'm the MLA in Halifax, Clayton Park, and the chair of the Public Accounts Committee. And I'll turn it over to our support here today, the Auditor General's Office.
Evangeline Coleman said, Assistant Auditor General.
Jacques Lapointe, Auditor General.
Darlene Henry, Committee Clerk.
Nancy McNeil-Smith, Superintendent of Pensions.
Thank you very much. And with that, I'd like to turn it over to Ms. McNeil-Smith to see if you have any opening comments, if you'd like to give us a bit of context for today's meeting. Thank you very much.
Good morning. Thank you for providing me with this opportunity to speak to you about the operation of the Pension Regulation Division and the application of the Pension Benefits Act to the municipal and private sector pension plans. I note in the material that was sent to me that you do have some follow-up questions with respect to the Auditor General's report that was done previously. I would like to just reiterate that with respect to the regulation of pension plans, our goal is to ensure that the ultimate pension promise is met, so that our focus is in ensuring that the plan administrators and plan sponsors are have the proper tools and the knowledge and ability to administer the pension plans such that the members do ultimately receive the pensions that they're promised. And with that, I'll turn it back to you. Thank you.
Thank you very much. I appreciate that. And for the first 20 minutes, we'll begin with the Liberal Caucus, and I'll turn the floor over to Mr. Caldwell.
Thank you very much. You met with us some time ago now, I can recall, and we went through this whole process. But just to bring me back up to speed again, you regulate the municipal plans and what other ones?
Municipal plans and private sector plans. The pension legislation applies to the hospitals of Nova Scotia pension plans. That's one of our biggest plans. The legislation does not apply to the public service superannuation plan, the teachers pension plan, the judges plan, the MLA's plan, or Sydney Steelworkers plans. There's two plans there.
The process that's gone through with the universities, you look after university ones?
Yes, we do, yeah.
Okay. Now, and the municipalities, of course, as you already said.
Yes.
What kind of shape is the municipal HRM's pension plan in at the present time?
The specifics on the plan's assessed every 3 years, and those reports are filed with my office for review. So the last review of the HRM plan was in December 31st of 2007. And so the next review has to be prepared as at the end of this year. So, and the municipalities have been given a specific exemption for funding solvency deficiencies under the plan. Right now, they only have to fund until the plan reaches 85% of solvency, and those rules apply until 2016. So at the last valuation, HRM did not have to make any additional solvency payments because they were more than the 85% funded. I don't know what their funding status will be on December 31st of 2010.
Okay. And if they're below the 85%, what kind of action?
They would be required to make special payments, which is additional money, contributions made to bring them up at least to the 85%. Generally, under pension regulators across the country feel that if you're at 90% funded, You don't have to do a lot of tweaking to the plan to bring it up into the full funding level. But once you're below the 90%, then the plan administrator, the plan sponsors, and the employees have to take some direct action in order to restore the plan to full funding. So that issue has been left with the municipalities to wrestle with, as far as how are they going to bring the plan back into full funding. Similar to what the action the province took yesterday with respect to the public service superannuation plan. Left on its own, the plan would run out of money. So that action had to be taken as far as the benefit payments that were being made in order to restore the plan to good health.
Yeah, and just use the provincial one as an example, because I know you don't regulate that. But the actions, typically how long would be allowed, or should it take to, like the province said, they're about 69% funded. I'm just using for an example. How quickly would, typically, if you were administrating a private one or a municipality, would you require them to be up to the 95%, for instance?
We would normally require a pension plan to bring it up to 100% solvency within a 5-year period. Now, because of the fall in the financial markets in 2008, the government amended the regulations under the Pension Benefits Act, which would allow pension plans that were less than 100% funded to fund any deficiency over a 10-year period instead of the 5-year period. And that was to address the specific concerns with the fall in the markets, because assets for most pension plans dropped about an average 20%, anywhere between 15 and 30, but normally 20%. Now, it's my understanding from reports that are coming in now that most pension plans are very near what their December or their pre-fall in the market asset values were. So the markets have recovered to that extent, but they haven't recovered as far as what they should have earned in 2009 and what they're earning now. So there's still a gap there, but there's been a big recovery.
That's positive. That's one thing we like to hear.
Yes. Yeah.
Being an MLA, we see a lot of people in our offices that don't have adequate pension funds, and causes a great deal of grief upon retirement. So it's important that these are kept up. Is another section of the Act that you look into, is the government considering any changes in the legislation that you're aware of?
Yes, the government currently, the department released a consultation paper on proposed changes to the Act and the regulations. Commentary is to be back to the policy division of the department in mid-April.
Okay. What sort of things are they maybe considering?
I'm not directly involved in the consultation. I guess the biggest one is looking at what the funding requirement should be long-term. It's an issue that's being looked at all across the country. There were consultation papers in Alberta and BC. There was a joint one. There's one in Ontario. Federal government, Finance Canada, is also looking at that. So in my discussions with the other regulators across the country, we're all looking at what changes are going to be made to the funding requirements, what other jurisdictions are considering. Hopefully we'll all move in the same direction, have the same requirements, most particularly because there are a lot of Nova Scotians participating in pension plans that are registered in other jurisdictions. So you might have an Ontario plan that has, might have 5,000 members and have 500 in Nova Scotia. So it would be good that we would have the same treatment of those Nova Scotia members in the Ontario registered plan as the other Ontario members. So we're trying to harmonize as much as possible across the country.
I know it's a big issue we had when the Trenton Steelworks closed, and what was the final result of that when that all closed? I know we changed the legislation, but to me it seemed like a little bit too late.
Well, it wasn't that the legislation was too late. The change that was made was to require an employer to fully fund a pension plan on wind-up. The situation with Trenton Works is that the employer went bankrupt, and then we would normally look to the assets of the employer to fund the deficiency and wind-up. But in the circumstance with Trenton Works, there were really no assets left at the end of the day after the secured creditors had been paid off. So the plan benefits were reduced by about 8%, and the assets for pensioners, pensions were purchased from a life insurance company, and for the active members who weren't retiring, the benefits are transferred out to their locked-in retirement accounts. Now, because of the economic situation in Trenton at the time and the fact that there weren't a whole lot of other jobs for these employees to go to, there were a significant number of former Trenton workers who applied to unlock some pension funds for reasons of financial hardship. We had their pension funds were released in December of the previous year, 2008. So we had a lot of applications come through in January for financial hardship, and the majority of those applicants were approved. Now, interestingly enough, applicants can apply once every 12 months on the basis of low income, and although we had expected a lot of these Trenton workers to come back to apply for unlocking more funds, they have not. So that it seems to me that these individuals have obtained employment and they're working and they don't need to access their funds anymore. We have the odd Trenton worker applying, but it's very, very low in numbers. So it's very good news in that sense.
It's nice to have some good news out of that whole thing.
Yes.
It was a very bad situation for everybody. In your view, are defined benefits plans better than defined contribution plans for employees?
I would say most definitely, because with a defined benefit plan, you have the promise of the benefit that you're going to have on retirement. You're not responsible for doing the investments, and you're sharing the risk of outliving your money with the other plan members in the pension plan. If you're in a defined contribution plan, it's very similar to having money in an RRSP. You accumulate you make contributions, the assets accumulate in value over time, but you really don't know how long you don't know how long you're going to live. So if you have $200,000 at retirement at age 65, how much should you actually be spending from now until your unknown date of death? Right? And you're doing the investment yourself, so you have to be generally pension plan. A pension plan would hire experts to provide for investment direction and expertise. If you're self-directing your funds, you don't have that same level of expertise. I personally cannot invest my RRSPs the same manner as any of the pension plans that I supervise because they hire experts and I'm not an expert in investments. So there's a lot in favor of the defined benefit plan for an individual versus the defined contribution plan. However, defined benefit plans can be expensive to operate. You need a certain mass before it becomes worthwhile. We have seen in the past actuarial expenses paid to the actuary to value the pension plan that are equivalent to what the employer pays for the current service cost of benefits earned under the plan. So in that case, when your expenses are equal to the cost of your pension, you're too small. You shouldn't be having a defined benefit plan. We've seen a lot of mergers of smaller plans with bigger plans over the years, and then we've seen some plans that defined benefit plans that switch to defined contribution plans, but a lot have merged into bigger plans.
How difficult is it for, say for a small business in Nova Scotia, I know it's very difficult for them to build pension plans because it's an expensive long-term obligation, but important one. Is there anything in place that would allow all these small businesses to go together maybe with a bigger plan somewhere to really make it effective for their employees?
We do have, under the existing rules, the ability for various associations to get together to form a pension plan, and we have a number of them that are in place. For example, the Hospitals of Nova Scotia, the Nova Scotia Association of Health Organization pension plan has a large number of pension plan employers participating in that one plan. There are other municipal associations any type of association could group together to form one pension plan and share the cost that way.
That's really, that's positive, but really what I'm asking, if somebody, say in Sydney, has a small business with 10 employees, impossible to probably have a plan that's really cost effective in that small number of people. Is it possible for an organization like that to team up with 50 other organizations like that to get a plan that might make sense?
Under the existing rules, there's no ability to do that. The Canadian Association of Pension Supervisory Authorities, which is the superintendents across the country, we had worked on developing what we would call a model pension law for Canada, and that's where we would recommend to our governments, if you're going to make changes to your pension legislation, look to this model law to see where we think you should be going. One of the recommendations in that is for what's called a simplified pension plan, where you would have a financial institution like an insurance company be the plan administrator and do all of the responsibilities laid out in the legislation as far as administering a pension plan. And all the employers would be required to do would be to remit the contributions from payroll. So that is one of our recommendations. It's been very successful in Quebec. It's been in Manitoba as well. But as far as a province-wide defined benefit pension plan, there's been nothing recommended. The one that CAPSA had recommended was a defined contribution plan.
I'm just wondering, because in today's economy, when we're trying to, number one, keep people work here in Nova Scotia, which is quite critical, and as our population gets older and older, of course, there's more and more strain on the pension systems, but also you want to maintain young people, and young people really don't understand how important it is to build a pension, and I think everybody in this room was in that situation when they were of an age when they started working. But it would seem to make sense if you had something like that available to small business. You talk about all kinds of different organizations. They're generally mostly government funded one way or the other, if they're nonprofit or whatever they are, but they're still government funded. But for the ones that aren't, the businesses out there that maybe have 2, 3 employees, 10 employees, or even 50 employees that could tie into a pension system that might be province-wide, that could still be administered by an insurance company or whatever, something that's reputable and secure, if there's such a thing anymore today, in some of the financial institutions we've seen. But there seems to be that's a real gap. It's a real gap. And then at the end of the day, when people go to retire, the income isn't there. And most people live day to day and don't have the resources to put, $100 a paycheck away or a month, whatever the case may be, towards retirement, even in RSPs. So is there been any consideration for doing that? Because I think that would help stabilize the workforce in the province long term and make it a lot better for employers to attract experienced people to their businesses, maybe from outside the province even.
There's been an initiative started with the finance ministers across the country, both federal finance and the provincial finance ministers, in looking at what changes do we need to make to the retirement income systems in place in Canada to capture the group that you mentioned, the people who need pension coverage but are lacking it. So it's my understanding that a report has been made to the various ministers and that they're reviewing that currently. There are proposals relating to expansion of CPP benefits, implementing a private sector pension plan that various employers can participate in. They're looking at a number of options, but there has been no final recommendation made yet by any of the governments.
Yes, as I know personally from dealing with people again in my own area and I think it's the same right across the whole province, that when someone gets a guaranteed income supplement, their income is pretty darn low, and just about impossible to survive on that kind of income today, and that's going to get worse and worse as taxes continue to increase and as everything else seems to go up. and there's nothing there to help people along, and they're not an age typically they can go back to work and help supplement their pensions. In some cases people do, they have to, and they don't want to, but they have to. But when they get past the time when they can work, then the real trouble sets in, and it takes a long time for that lack of income to accumulate. And when it does, then they've got a major problem on their hands. So and I know you can't probably answer this question, but how much urgency has the government put on this? I mean, I think this is something that sooner something is done, the better.
It has a high priority among the governments across the country because the nature of pension plans is that pension benefits are earned over time. Money invested has to be invested over time period in order to do any good. You can't establish a pension plan and within 2 years be providing generous pension benefits. You earn a benefit each year that you work, so that any fix that's put in place now, it will take some time before it starts to show any effect.
That's my point exactly. And is it something the province could do by themselves? I mean, just here in Nova Scotia and work with employers to set something like this up?
Of course, the province could do something on its own, but the administrative costs of something could be very high. And if you can do something nationally, then that's, to my mind, would work much better. You've got a much bigger group of employers to deal with to share administration costs with the investment costs. You also don't then run into problems if you have employees moving from province to province for employment. I think that we're facing a time when we're going to have a lot of labor mobility, so that anything we can do to assist in that is worthwhile.
Thank you. Mr. Colwell, your time's just about up, maybe just 30 seconds.
Okay. Maybe at the end of the today you can talk about the Quebec system. They have a system similar to this in place, is that what you said earlier?
Yes, they have the simplified defined contribution plan in place, and the rules are simpler, much simpler for the employers. Yeah.
Thank you.
Thank you very much, and your time has elapsed, so I will now turn the floor over to Mr. Porter for the Conservative Caucus for the next 20 minutes.
Thank you, Madam Chair, and thanks for being here, Ms. McNeil-Smith. Pensions, very interesting topic. I think widely, though, that's something that a lot of people don't understand. You go to work, you get a job, they say you can pay into the pension plan, you pay into it, and we don't think about it for quite a few years, and we don't really think about our money, I don't think, in general, especially when we're younger. So I wonder if you could simply put, Simply Pensions 101, a brief overview of what people, I don't know how I can put it, but just simply, how does the pension work? So you get a job, and you have an opportunity to pay into a pension plan, and I'm doing this for a reason, and I'll come back to that after, but can you give me, just for the record, a little brief overview of pensions in general, what our options are, and how that works?
Certainly. When an employer decides to offer a pension plan for its employees, the employer may or may not involve the employees in the design of that plan. If they're unionized, generally they would, but if they're not unionized, the employer would look to establish terms and conditions under the pension plan that will achieve the objectives, which are to ensure that their employees will have some assets when they retire, something they can live on. Generally, the employer will make participation in a pension plan mandatory. It then becomes a term and condition of employment. When participation in a plan is voluntary, people generally don't join in time. Right? They don't start thinking about pensions until they're in their late 40s or 50s. And if you join a pension plan at that time, even if you work till 65, you still aren't going to have a very good pension. So the employer will decide what risk it can bear. Does it want to offer a simple defined contribution pension plan? If it does, if it I'll take that one for first example. Defined contribution pension plan, the employer selects the fund holder. Under a pension plan, the pension assets have to be held separate and apart from the assets of the employer. So the employer chooses the financial institution that's going to hold the funds. Usually for smaller employers, it's an insurance company. They establish their contribution rate. The employer will say, I'm going to contribute 5% of payroll, and the employees are going to match that. So it'll be 5 and 5, 10% of earnings overall going into the pension plan. The type of investments that are available for investing those funds, the employer generally selects a number of investments, but a limited number, because they're required to make sure that the assets of the plan are invested prudently. So if it's a pension plan where the employees get to choose where the money's invested, they choose from a limited range that's been selected by the employer. So the employer is not going to give them the option of investing in a South American gold company. That's not a prudent investment generally for pension funds. So the employer then monitors the plan, makes sure that the investment options provided to the employees are appropriate. They may do something that's more common now in that their assets shift as an employee gets older, so that you move from less or more, you move away from equity into more bond type of investments when you're nearing retirement. And that should stabilize the asset fluctuations, so that when you actually do need to retire and start receiving income from the funds, it's not in the middle of one of these drops. Under a defined benefit plan, the employer again decides they're going to assume basically there's more of a risk for the employer under a defined benefit plan. The employee contribution rate is generally established, and the employer is responsible for paying the cost of the plan that's over and above what the employees can contribute. So if the benefits earned every year under a defined contribution plan are 15% and the employees contribute 5%, then the employer's responsibility is to pay that 10%. The plan is assessed every 3 years to determine what the cost is for the benefits that are currently being earned. The costs increase as the employee group ages. So if generally your employee group is aged 40, and through changes in the structure of who you've got hired 3 years later, that the age is actually 42 now. You've had fewer new young people come in and the older people are staying, then the cost of benefits earned every year is going to go up, and the employer is responsible for that increase in cost. But the employer is responsible for directing the investments of the plan and for administering the benefits and for paying the cost. That's about it.
Mr. Porter.
Thank you, and I appreciate that overview. And in the time frame you did it, that's a lot of knowledge in a few short minutes. I appreciate that. But it goes to a lot of questions really, and I wanted to get to it. Was how many years? You know, we talk about magic numbers. You hear all the time. Well, I need to have this. I need to have that. How many years do you need to pay into a pension to make it of a fair value when you retire?
Well,
and maybe along with that, just to simplify that a little bit more for you, for the answers, at what percentage? It's all part and parcel, I guess, anyway. So
that analysis is being looked at in the initiative that the federal finance ministers are spearheading. If your pension fund overall, your cost is 10% of payroll, that might provide you with a mediocre pension at retirement. When the pension benefit that you're earning over your lifetime is about, if it's anywhere near 15 or 20%, then you're going to have a pretty good pension. The general rule of thumb would be that if at age 65, you're going to need $10 for every $1 of annual income. So if you want $10,000 in annual pension, you need $100,000, right? If you want $20,000, you're going to need $200,000. So the numbers are big.
yeah. Okay, I guess my next question then on that is, so there's always a certain amount of risk in this pension investment. I was part of a pension in a previous life where everything that you paid in, as well as what the employer paid in, was all at risk. And it was totally based on the markets, where if the market dropped, so did your investment drop. There was no guarantee. You could have actually ended up with zero if the markets bottomed out. Are you familiar with that kind of plan?
Well, if it's a defined contribution plan, yes, but the structure that's in place for the employers are that they're required to make sure that the investments of the plan are prudent. And the requirement is that you're going to make sure that the investments are, and in doing the investments, you're handling money with the standard of care that you would handle someone else's money, in that you're going to be more cautious than if it's your own money, right?
I understand that fully. I guess what I'm getting at here is, in this example, and I'll come back to why it's important. In this example, we were all given a brief overview. The investment company comes in, or somebody from the financial world comes in and says, well, here are all the options you can choose from, but it's up to you what you want to pick. How is that prudent? And I'm assuming that doesn't happen in what you're overseeing.
No, because there are requirements under the legislation for prudent investments. We also have what's called the Capital Accumulation Plan guidelines that are established nationally under CAPSA. And those guidelines assist the administrators in ensuring that the example you provided doesn't happen. Under the CAP guidelines, the employer is required to select out of the whole 50 possible investments that an insurance company may provide for your RSPs or pension plans, that of those 50, the employer is going to choose maybe at most 10 that are available for employees to invest their pension money in.
So they're limiting actually what I could invest in anyway of the entire group.
Yes.
They're saying this is your pocket to choose from, and hopefully they're going to guide me through that.
Yes.
Prudently and to my benefit in the far years down the road.
Yeah. Under the CAP guidelines, there's a requirement of making sure that employees receive proper information, that they're given investment or education opportunities to learn more about which options to select. Also, one of the features being promoted now is, as I had mentioned, that once you reach, they're called lifestyle funds. Once you reach a certain stage in your life, a certain age, then your investment options will be redirected into something even more conservative.
You talked a lot about the 3-year bit for the overview. Why or how do you get to the 3 years? And I'm just thinking about the fluctuation of markets. Things have been a bit volatile over the last few years. They're probably still going to be in a year or two, maybe ahead. They're always volatile anyway. You never know what the markets are going to do, and there's lots of analysts that can probably tell you that. But how do you justify 3 years as opposed to annually?
Well, the 3 years, as you say, is a snapshot, a particular point in time. It may be a good point in time, or it may be a bad point in time. Doing valuations is an expensive process with the data analysis, the market analysis, and also just the actuarial fees that are involved. So the 3-year is a standard across the country for assessing pension plans. Generally, there's not the fluctuations that we've seen. We had 2001, and then we had 2008, two very, very unusual events. We hope that they would not occur again, but they're not the norm, right? It was not a very good 10-year period. Now I've lost my train of thought.
That's okay. That'll lead me into my next question anyway, because we talk about the risk always in these pensions, and people, certainly like myself, wonder how are we making money on the investments of our pension, because our RSPs, for example, aren't making any money. You can invest in those and you're not making much by way of interest, or at least it doesn't appear like we are. How are the pensions different than the RSP contributions?
Again, it relates back to the choice of the investments that are offered under the pension plans, that they are generally more conservative. You might not have the wide swings in the asset values, they don't drop as low, they may not go as high, but they're more conservative.
So they can go in and choose the low or medium risk or what have you, and
Yeah.
hope for the best as the markets do their thing and the banks do their thing, and by way of making money. It's totally wide open to, again, the market values, the ups, the downs, the volatility, and all of that.
Yeah. I mean, underlying investments, I mean, when I learned about investments years ago, you do have investments that are good value investments. There's strong companies, good rates of return. And so those are the things that pension plans focus on,
Right. So
not the Nortels.
in one of your early comments there, I think in the opening comment, you mentioned about the pension promise is met by way of administrators and sponsors. And is that what you do specifically, making sure that, you know, you can look back over time, and there are investments, as you've just said, where they've been fairly stable regardless of the markets. They may fluctuate very, very little. Is that where the majority of folks are invested in by way of pensions?
They have, generally there's this, might be 30% invested in Canadian equities. There's some, maybe 20% in bonds. There's some foreign equities, U.S. equities. The spread should be such that your fund is protected, so that if there's a decline in one area, then it's not going to negatively impact in your whole portfolio.
Yeah, okay, thanks. I understand that very much. So I guess it's probably too hard to ask the question. I was thinking, and that's how much fluctuation is there. But that would, again, it probably depends daily on the way that the markets do their business as well, and the trading and so on. But you talked a bit about financial hardships and others coming to you making application to draw funds. Drawing funds from where? I just wanted to clarify.
When a person terminates employment, and if they're not retirement age, they are entitled to transfer their value of their pension funds out into what we would call a locked-in RRSP, a locked-in retirement account.
So in that example, those pensions weren't lost, or those funds weren't lost, they were just locked in.
Yeah, they're locked in. So when an individual leaves employment, they transfer the value of their pension benefits out to a LIRA, and they do direct the investments themselves. We do have provisions under the legislation to allow for unlocking of these pension funds for reasons of financial hardship. There's 3 criteria of financial hardship. The first is for mortgage arrears, where you're facing foreclosure. An individual may apply and be granted unlocking on that basis once in a lifetime. The second is for medical expenses that aren't covered under any other program. And it's medical expenses necessary to treat an illness or disability. So it has to meet that criteria. And then the third is for low income, where your income is less than, currently this year, $18,880. So for individuals whose expected annual income over the next 12 months is less than $18,880, they can apply to unlock their pension funds.
Can they draw only up to that 18,000 figure?
Yes.
And are they, I'm going to assume this one, I would think the answer is yes, they're taxed appropriately on the money they withdraw, are they?
Yes. Okay. Yes, and it does impact, if an individual is receiving community services benefits and they unlock pension funds, it will impact the payment of those funds, the community services benefits, yeah.
Claw back for that, and you mean dollar for dollar. Is it dollar for dollar on that as well as it is? I know there's a bit of, I forget the actual figure now, there's a bit of room there that you can make a few dollars, but.
Yeah, there is some. It's up to a limit. I'm not quite sure what it is each month. But in some instances, if an individual would say would withdraw 1880, then their community services benefits would cease.
Okay. And by way of guarantees, and that's a strong word when it comes to risk-type investments. Are there guarantees that pensions will be there for the folks that are paying into them today? Based on the based on the kind of legislation we have in place, does it need to be stronger, and based on the plans that the majority of people that you deal with are invested in?
Yeah. The guarantees come with a price, right? So what the goal of the pension legislation is to make sure that the benefits are there in the long term, but we don't want to be so onerous that to ensure 100% guarantee, it's going to cost so much that plans won't be offered by employers. So it's the balancing act is you can make it very expensive and very secure. You can make it less expensive less secure, there's some risk there, but is that risk tolerable, right? Or you can go back to no regulation and all risk.
So I know I've got a couple minutes left, but I wanted to ask you, the end result.
3 minutes.
3 minutes, thank you, Madam
Yeah,
Chair.
just-
The end result is, obviously, I want to have a pension at 55, 65, whenever I decide to retire. And you gave a figure a little while ago about what I should be looking at. How do I reach that, though? I guess I don't really think about what I'm accumulating in pension, what I'm investing. I don't think too much about at this point in time in my life. I'm starting to think more about it as I'm approaching that, but I mean, how do I know, how do people know in general what they need to invest and what they're going to need when they turn 65? How much money am I going to need to live on?
Yeah.
I guess if I'm paying, my salary today is whatever it is, let's say it's $50,000 a year, I want to make sure I have at least somewhere near that at retirement. How do I get there? Are these plans set up to design? Is the design there for that?
Well, when you're looking at your retirement income, you have to consider you're going to be getting old age security and you're going to be getting CPP. So it's not all going, all of your retirement funds aren't coming from your own pension plan.
So it's about having enough to add up with the others that you should have or projected to be
That's right.
comfortable, I guess, for lack of a better word, to get you there then.
Yeah, and I'm on a CAPSA committee for defined contribution pension plans. We're looking at and we're working with the industry as well on this. What do we need to do as regulators, or what does industry need to do to ensure that members do have that information? In particular, are there are internet, I guess, features available that will allow for projections to retirement. If you contribute this amount, your investments are this, then this is what you would have at retirement. So it's just making sure that that's provided to the pension plan members.
I think that's a good plan, and I think a lot of people really don't understand the whole pension plan idea, as you suggested earlier on, especially when we're younger. We're the 25, 30, we're working, we're making a little contribution now. Yeah, someday I'll retire, and that seems like a lifetime away. But strangely enough, the years go by quickly, and pretty soon you're thinking about that. So I think it's good that you're part of that, and I know myself will be looking forward to what that brings us by way of a guarantee, for lack of a better word, when my time does come to retire off. So thanks very much for your time this morning.
Thank you very much, Mr. Porter, and your timing was perfect. We have the next 20 minutes allocated for the NDP Caucus, and I will call upon Mr. Pereira.
Thank you, Madam Chair, and thank you, Ms. McNeil-Smith, for coming in this morning. It's been a real education for us, and I especially enjoyed the questions that Mr. Porter asked. I didn't know you gave investment advice as well. I do want to follow up on his last comment. I was, my daughter asked me this morning what I would be doing, and I said, well, I'm going to go public accounts, and we're going to be talking about pensions. And she said, that's so boring. And I think it is part of a general, and she's a university, a commerce student. We still haven't made that kind of impact on people that pensions are important, probably the most important decision, we'll be making. And that the political culture really hasn't changed around pensions. It is somewhat dry, but also very important. I'm glad you're here today. I wanted to take you back to the Auditor General's recommendations, the 5 recommendations, and we'll start with just recommendation 1. And the Auditor General says the division does not independently verify whether pension plan investment policies are prudent, approved policies have been implemented, or whether they're being properly monitored and comply with the Act. In addition, there's no verification of whether the market value of plan assets being reported annually by the administrators is accurate and whether required contributions have been made. Relying primarily on information reported by plan administrators is not sufficient. The department at the time, the minister at the time said that that recommendation would be adopted and that we would be requiring periodic valuation of annual returns consistent with regulatory principles for a model pension plan developed by the Canadian Association of Pension Supervisory Authorities. I can't say I understand that answer, and I just want to know, what does periodic mean, and is that appropriate under the circumstances? And what regulatory principles for model pension plan auditing are we following at the moment, at the current time?
Well, currently, there is no requirement under the pension legislation for a plan administrator to file financial statements on a pension plan. I do have the right to ask for them on a plan-by-plan basis, but there's no requirement that they're automatically filed. Now, I had referred earlier to the model pension law that was developed by CAFSA. And in that model law, there is a recommendation that governments do require filing of financial statements in certain circumstances where the pension plan assets are held in the general assets of a life insurance company. For the smaller defined contribution plans, that's generally where the money is. Those pension plans would not be required to file financial statements. They're already subject to auditing under the insurance regime that exists in Canada. The pension plan assets that are more than $5 million, for those types of plans, there would be a requirement to file the audited financial statements. So those are the recommendations that we would like to make to government when we look at revising the pension legislation.
So, sorry, just to understand then, that government statement at the time that audited financial statements would be required, was that ever followed up on? Was that
well, we need changes to the legislation in order to do that. So we had had the review of the pension legislation. There was an independent panel made recommendations that were given to government in January of 2009. And then, as you know, the government changed. And we've had discussions with the minister since then, and we've released another consultation document where responses are due back mid-April, the middle of this month. And from those subsequent consultations, we would expect to develop a package of recommendations to the government for changes that would allow us to implement the recommendations of the Auditor General.
So the department's general preference is that these administrators and these plans just provide audited financial statements. Is that what it seems to come down to in terms of best practices, rather than the department itself, the agency itself doing it?
We are not auditors. If you wanted us to assume an audit function, then we would require staff that are auditors, trained in auditing and going out and doing that. It's generally, and we would rely on the plan administrator to be fulfilling their role properly. There are, as I'd indicated, the financial institutions are already audited. And the biggest driver to me in ensuring that a plan is properly administered and that the information is correct is the cost to the employer. If the information is not accurate and the employer is ultimately responsible in a cash sense. If the funds aren't accurate, then they do have to make up any shortfall that exists. So it's in the best interest of the employer and the plan administrator to be as accurate as possible in all of their reporting.
Okay. Thank you. I want to ask about another recommendation. The Auditor General was talking about performance measures for the supervision of defined contribution pension plans. Where are we with that? Are there performance measures now in place that are acceptable and satisfactory?
Yeah, we are currently tabulating the reports on non-remittance of contributions to defined contribution plan. As per our discussions earlier, a defined contribution plan, the employees generally select the investments from a limited group of investment funds chosen by the employer. But the biggest risk under a defined contribution plan is just that the money is not paid into the pension plan. There's a requirement under the legislation that the plan administrators report any non-remittance to me. We do get notifications from insurance companies periodically of plans that have not remitted the funds, that they're late in paying the funds. So we follow up on all instances of advice of non-remittance and make sure that the funds are being remitted properly. So we're tabulating those numbers and keeping track of how long it's taking us to respond.
Let me just, that takes me nicely into the more contentious and controversial recommendation in the Auditor General's report, and that is recommendation 5.2, where the Auditor General says the Pension Regulation Division should implement a process to periodically verify that pension plan assets are prudently invested. The division should also verify assets are invested in accordance with legislation, and that the plan statement of the investment policies and procedures. And the department at the time, I think it was the only recommendation that the department and the minister took issue with. Could you explain to me what was at issue in that recommendation and why that recommendation was not followed up on?
Well, it's the administrator's responsibility under the legislation to ensure that assets are invested prudently. Now, and prudence is a rule of process. You can't look at a pension plan investments in isolation and say, okay, we have investments in Nova Scotia Power, we've got investments in South American Gold Company. Are they prudent? Looking at them independently on that basis, you could not necessarily eliminate the South American Gold Company. What you need to do is to look at the rules of process. What processes do the administrators have in place for determining are the investments in line with the objectives of the pension plan? You may have a very large pension fund that may invest like 0.5% of its total assets in the South American Gold Company. That may be very prudent. So the administrator establishes the process that are in place there as far as what are the goals of the pension plan, how do we choose the investment advisors, what limitations are given to the investment advisors as to the range of responsibilities. It's prudence is really just that rule of process.
So to understand you correctly, the agency doesn't want to take responsibility for as to whether or not monies have been invested prudently, but the agency is principally interested in ensuring that procedures are in place that would allow the administrator to come to those prudent conclusions.
The prudence is the process. It is nothing other than that. So that what we have done, no government in Canada inspects pension plan assets to determine whether or not they're prudent. What we are working on nationally is guidelines for plan administrators to enable them to demonstrate that, yes, indeed, they have been prudent in their investments. So CAPSA has a subcommittee that's looking at prudence of investment processes and developing guidelines that will assist regulators and plan administrators and plan sponsors in ensuring that each of the functions have been met.
No, I know, I'm not sure I understand the complexities of all of this, but I was union president for a number of terms at St. Mary's University, and it was always an issue, especially in the last few years where there's been a lot of turbulence in the market as to whether or not, you know, we should invest in the housing market or in a particular company or in natural resources or in Canadian companies or American companies. What guidelines are you aiming for? I know you're talking about the establishment of general guidelines. What defines prudence? What touchstones or what bases do you use for establishing prudence?
Well, I mean, in prudence, you look at who's responsible for what. So it's very specific as far as you have the administrator, you establish the statement of investment policies and procedures. What are the goals? What are your restrictions you're going to in place? Who's the investment advisor, right? It's setting out roles and responsibilities for each party involved in the operation of the pension plan. And there are restrictions with respect to knowledge. You must ensure that the people or the parties that you get involved in the operation of your pension plan have sufficient knowledge to do their, to fulfill their functions. And if you as administrator don't have the knowledge that you need, you have to obtain it either through education or by hiring experts who do have the knowledge. There's requirements with respect to conflict of interest. You must ensure that the parties involved in the process do not have any conflicts of interest, and you must have procedures in place for if a conflict arises, how are you going to address that? So everything has to be laid out in process. There are requirements under the legislation for specific, besides investment of assets prudently, there's specific limits on investments. So you have to ensure that the parties involved in the investments meet those limits. Again, CAPS has done a lot of work on what we would call the whole governance of the plan to make sure that that all of the features of the plan are handled properly.
Okay.
Mr. Farrell?
Sorry, I thought you were finishing off that sentence. How does the agency manage risk for plan members? You know, I think that's what it comes. I know in the policies we had, the administrator would say, well, you know, if you're a young faculty, you can take a little more risk and choose that portfolio. If you're not, you can do this. Or if you're senior faculty ready to retire, you should move into these types of packages. I'm assuming that the agency doesn't get into that level of detail about risk and risk management for the members. You're still interested only in the larger governance of the plan itself, that you have no way of, there's no alarm bell that's triggered in your in the agency if something seems out of kilter, that this plan is too heavily invested in mortgages in the U.S., for example.
No, we do look at plans specifically. In the pension plan that you participated in, the university is required to ensure that the options provided to you are balanced overall, that they're not going to provide too much risk. The institutions also ensure that there's training modules available, educational tools to assist you in making your investment choices. As I indicated to you, the industry overall is looking more at lifestyle funds. As you get older, you probably should shift your investments more to one way or another. Of course, there's individual decisions that come into play. If you have sufficient other funds, like a property that you own, or you have other resources and you're not relying entirely on your pension for your income, then that gives you a different perspective and may lead to different choices than for someone else who was relying solely on their pension plan for their income. But there are all tools for these plans, and there are guidelines under the capital accumulation plan guidelines that assist the administrator in meeting their responsibilities, just in making sure that those assets, the investment options available to you, are appropriate.
Can you expect, or there seems to be an expectation that the agency will exercise more of an oversight function over these pension plans, given the fact that so many of them appear to be in difficulty? Do you see the agency moving more into sort of looking at the due diligence part that was previously the responsibility of plan administrators, and advising them and guiding them and saying that in itself may not be prudent, although I understand that, you know, your definition of prudence here depends very much on what the administrators want to do and what the degree of risk they want to expose themselves to.
Yeah, we have actually spoken to plan administrators about the investments of particular of their pension plans. In the past, I've done that in a number of occasions over the years, not a lot, but in some, and made recommendations to them that you should focus on this particular aspect of your pension plan and make improvements in it. So we have exercised that oversight function already. Whether or not we're going to be doing more of an audit function on pension plans, we would need more staff to do that. I'm not sure that in our analysis of pension plans, you have to identify what is the risk, right? If you're going to provide regulatory oversight to address a specific risk, what is the risk? With respect to investments, the risk is less in the sense that the employer is ultimately responsible if the investments don't work. So that is the biggest hammer to ensure proper governance of the pension plan than anything that I could impose, because it's the money coming out of the employer's pocket, right? We will be, through CAPSA, looking at providing more guidance and guidelines and educational tools for administrators to make sure they know how to do their job properly. And that education is a big regulatory tool as well. It's not just audit, and then it's not just reviewing, it's helping plan sponsors to do the right thing. Because the plan sponsors generally who provide pension plans are good employers, right? They want to do the right thing, and it's my role as a regulator to help them do the right thing as well.
Well, I'm glad you're doing that, because I know that certainly in my limited experience, and you were talking earlier about the knowledge standard, most of the people who sit on these committees and boards tend to be people who are interested in the issue and may have some experience, but there's no real requirement that they have that degree of knowledge or training. Most of that work, certainly in my experience, is farmed out to a professional body like an auditing company that will do it for you. But the people who are actually sitting at the table are really just ordinary people trying to do a very difficult job, and I'm glad to hear that there'll be a little more training for them.
Yes, it's to us that nationally that's what we're focusing on, is ensuring that people are adequately trained and they have the knowledge and tools to do the job that they have to do, because it's always volunteer work.
Yeah.
In that sense, it's not you don't go out and hire a member of a board for a pension plan.
Yeah, several $1 million at stake, sometimes $1 billion, and you've got a volunteer board.
Yeah, and in some cases, the pension plan assets are bigger than the assets of the company.
Yeah.
Right? The operation of the pension plan is as big a business as the business.
I'm assuming I'm out of time. I have a quick
just coming up to
question.
Yeah, you're done. It's
Thank you, Madam Chair.
10:05, which is right on the mark. Yeah, thank you very much. And there will be a second round of 15 minutes for each of the caucuses, just so that you can save those good questions for the next round. I'd like to turn the floor over now to Mr. Caldwell of the Liberal Caucus, and you have 15 minutes.
Thank you. Back to the establishment of a sort of a provincial or national pension plan. What's a population threshold to establish such a plan for, say, employers outside the provincial government plan? There must be a magic number there somewhere. Quebec has one, and is that one efficient at the population they have? I don't know what Quebec's population is there at the moment, but...
Yeah. What Quebec did under its simplified pension plan rules, it allowed, it's not operated by the Quebec government itself. They allow financial institutions like insurance companies to set up what they call a simplified pension plan, where unrelated employers can participate. It operates, it's like a large defined contribution pension plan. All that an employer does and all the employees do is just pay the money into the pension plan, and the insurance company acts as the administrator and does all of the investment concerns. So it's not, so the individual employer is not responsible for choosing the investment options provided or managing the pension fund at all. That's done by the insurance company because they're the administrator. So it removes all of the duties and responsibilities from the employer and puts them on the insurance company. That simplifies things because, as Mr. Preya had said, you have to have an educated board in order to make the proper decisions relating to the pension plan, or you have to have the educated administrator, and that is a lot of responsibility. So the simplified pension plan is attractive to employers in that it relieves them of those duties.
The population of the province now, would that system like that work?
I believe it would. I'm not sure what it would do overall to increase pension coverage. In Quebec, when they first changed the rules, it really didn't take off, and it was not successful because they had prohibited existing defined contribution plans from becoming simplified pension plans. But they removed that barrier, and now existing plans can move into the simplified version, and they are seeing growth in coverage now. But it did take a number of years for it to become successful.
Would something like that work better if it was like the Atlantic region or the Maritime region doing that? Because a lot of common things that we have in the state of Atlantic Canada.
Yeah, I would support a regional plan. It would certainly work very well.
And learning from the Quebec experience, probably uptake would be a lot quicker once businesses and other organizations realized what it was.
Yeah. I guess it's a matter of educating employers and employees as well in just how important it is to have a pension plan, retirement savings. And with a pension plan, there's no drop in contributions if, in the same way that you would have under personal RSPs, right? You may choose as an individual not to contribute to your retirement savings in 1 year, but if you're in a pension plan, you're forced to contribute every year. And that makes a huge difference in the ultimate outcome as far as what the amount of the pension benefit would be.
Yes, back to the HRM, and I just use HRM as an example because we have many municipalities here in the province. Some of them are quite small and must be really struggling with their pension plans. Are any of the municipalities gone together to address this?
The Union of Nova Scotia Municipalities does have a pension plan for its members. It's a defined contribution plan. So they do already pool their resources together to operate that.
Is that working well or appear to be, or?
Well, it works as well as any defined contribution pension plan. The money's going in and the assets are invested and the members are getting benefits, so. Yes.
Are all the municipalities involved in that or just a few?
There are municipalities that have their own pension plan. So it's generally the smaller municipalities that are in the group pension plan.
Now, you indicated that the HRM has a sort of a break from the exemption from being fully funded to 85%, I believe it was. And is this something you think is positive to continue beyond this, or is it something that should be changed so they can maintain it to 85%, or should they really be closer to the 100%?
It's my belief that the solvency test is the appropriate test for pension plans. It's not about whether or not you have enough assets to pay all the benefits if the plan was wound up. The solvency test is really, it's a stress test, the indicator of the health of the pension plan. It is the test that is now recommended by the Canadian Institute of Actuaries. It's recommended by the International Accounting Standards Board for valuation. So the solvency is the appropriate way to assess the liabilities of the pension plan. The same way that it's a market value assessment. So it's the same way as market value is the way your property is assessed for tax purposes. So the method of assessment is appropriate. What's up to governments is to determine if the assessment reveals that there's an unfunded liability, how long do you give the employers to make up for that deficiency? So to me, the role of government is to determine what is that length of period for making up for the deficiency.
And I believe I heard you properly, and I think I did, that basically I'm just going to talk about HRM about this because it's an issue. So if HRM didn't invest properly, their investment people didn't invest properly, that's going to cause a problem. Or in general, the markets drop and that doesn't happen, or they don't contribute enough to bring this up to date. There's no way of really policing to see if they've invested this properly. Is there any way to do that?
We certainly do have the ability to police. If we had a question regarding the investment of the HRM pension fund, we would have the ability to go in and look at the documents relating to the investment. Again, it would fall into an issue of were the investments prudent? So we would have to look at, are the procedures in place for determining who makes the investments, if they're done in accordance with the direction of the plan administrator. All of that process would be followed. But there's never been any questions raised about the nature of the investments of the pension plan.
Probably, I'm guessing it's probably because some of the people that are in the pension plan, I've got some inquiries from people that are in this pension plan that probably didn't realize that could happen. That's probably the reason you haven't got the inquiry. That'd be my bet. But that's just a guess on my part. So this...
sorry, Mr. Pereira, did you have a comment?
Just a point of order. I want to make sure that the member is not saying that the HRM pension plans are in trouble or that there's any conflict there, that you're talking about it in general.
Mr. Caldwell, you have the floor.
I'm talking about just in general. I thought it was clear with that, but evidently I'm not. Yeah, it's an issue that the funding, well, there is a problem with the pension plan because it's not indexed, it hasn't been indexed in a number of years, so that is an issue and that is a problem. And for pensions that people have retired some years ago and has caused them a great deal of financial stress. And I guess from that standpoint, it is in trouble. And the fact that they don't have 100% funding as they're supposed to have, and struggling from what we recently received a briefing from the municipality, and this topic was brought up, and they're having a great deal of trouble keeping up to the 85%. And do you feel, as administrator for this plan, that they really should be at some point in the future up to the 100%?
I believe that all plans should be up to 100%, including government plans. The measure of whether or not you have enough assets to pay for the benefits in the long term should be whether or not the plan's solvent. There are plan design choices that employers have made over the years that impact the cost of the plan. If you have a pension plan that provides indexation, for example, they may have chosen not to provide for a bridging benefit on early retirement, or they may have decided that rather than paying a full 2% of pension for lifetime, they will reduce the pension at age 65, recognizing CPP benefits. They may decide that rather than providing for the cost of the survivor benefit to the pensioner, that the member would have to bear the cost. There are a number of plan design issues that impact cost, and so it's the choice of those design issues that would determine overall your cost of your plan. So if you have a plan that becomes unaffordable in the long term, then you have to make choices about your plan design. Can you afford the current design? And if not, what changes do you need to make?
And if typically if you go through a system like, and I'm just using municipalities for an example here, if you go through a process like that, is there regulations or changes they would have to make? Would they have to approach you with those changes, or is something they can do internally without any kind of consultation as long as they get up to where they're supposed to be?
Any amendments that are made to a pension plan have to be filed with me for approval. And if there's any changes prospectively that may reduce members' benefits, then the members do have to be notified of the changes.
Who regulates the provincial pension plan?
For provincial government employees?
Yes.
That's not regulated under the Pension Benefits Act.
No, that's strictly the provincial cabinet would control that basically under regulation, or?
It's my understanding it's again, it's not my responsibility. It's my understanding it's the Minister of Finance.
So they would have to come back and change like the contributions or the benefits or whatever the case may be.
Yeah, any changes would require amendments. Right?
Yeah. And would that have to go through cabinet, do you know? for approval?
Again, it's not any act would require, is not done, changes to any act is not done by cabinet. It would be done by an act of the legislature.
Okay. I just wanted to get your opinion on it, that's all, and I know you don't regulate it. I'm not trying to put you on the spot here in any way. The other issue, again, with a pension fund that is portable, I like that approach to pension legislation. And, you know, when you're young and you just start working, you don't really care, and you figure you're never going to reach retirement anyway, or whatever your excuse is. But if you can pay in those early years, it makes a huge difference, as you say, in the contributions and the benefit at the end. And when we look at possibly someday having a pension system, a country, a province across the country, or in the maritime or Atlantic region, it's going to take many, many years to get it up to a speed where it's really going to benefit people. How long do you think before something like this was initiated, before it really starts seeing a benefit down the road? Would it be 20 years, 50 years?
Generally, you'll be looking at something like 20 years, I would think, 15 to 20 years.
That would be to start to see a real positive benefit.
Well, that's when
from
you
it.
would start to see payouts.
Yeah.
Right?
And
that
then
would have any significance.
it would take many years after that before the plan sort of got itself well established and enough members into it to really benefit people. Would that be correct?
No, that would just be a factor of how well you sold it. I mean, if you put enough effort into it and were able to get enough employees enrolled in it, to me, that's just solely a function of your ability to sell the plan.
You have 1 minute left, Mr. Cole.
Thank you. It intrigues me because, and again, I say, and I'm sure all my colleagues here in the legislature and have the same problem. We see so many people in this province that are struggling because they didn't plan ahead, or they didn't have the ability to plan ahead because of income or whatever the case may be. And I really look forward to some kind of an improvement in this system, you know, in the province to start with, and hopefully across the country. And I asked the urgency on this. Is there real urgency, or is this something that's been talked about for 10 years and has really not gone anywhere so far?
We have not had the level of interest in pension plans that exist now for a long, long time. It's discussed everywhere at the provincial level, at the federal level, in all venues, and with labor and employer groups. So now I believe is the appropriate time that if there's anything that needs to be done, it will be done now.
Thank you.
Yeah, thank you very much. And with that, we'll turn the floor over to the Progressive Conservative Caucus and Mr. McMaster for 15 minutes. Thank you.
Thank you, Madam Chair. Ms. McNeil-Smith, how are you today? That's good. My first question involves a technical matter, and I'd like to give you an explanation, and perhaps you could give some commentary or some advice on it. This involves a real-life situation. I can assume this it's happened more than once. When the commuted value of a pension is taken, the lump sum is taken out of the pension plan. And in this case, there were two different cases. In the first case, there was a couple who were still married, and the spouses, they were living together. Of course, they're still married. And the commuted value was higher than the added amounts of another couple who, in this case, both gentlemen worked for the same organization, and they worked for the same number of years, so you would think they would have the same pension amounts coming out. But in the second case, where the couple was divorced and they were no longer living together, if you added up the amount that she got and that he got, they didn't come to the same amount as was in the first case. Could you give some explanation? Is there something under the legislation, pension legislation, that would cause that to happen? And if you have questions, you can ask them back if you're trying to clarify the situation.
The commuted value of a pension is basically its current value, its market value now. The values for two employees who have worked for the same length of time and participated in the pension plan the same length of time may be different, because the older you get, the more your pension is worth. So if you worked for 20 years and your coworker worked for 20 years, you both leave the plan at the same time. But if I'm age 60 at the time I leave and you're age 40, my pension's going to be worth an awful lot more than yours. Also, most defined benefit pension plans are based on earnings level. So although we worked for the same length of time, you made more money than I did, your pension's going to be worth more than mine because it's just a bigger pension because it's based on salary. So those factors can impact on why the commuted values differ.
Okay. Okay, thank you. And I do also know that when you have, because women live longer than men, there's an allowance made for that. So in some cases, a woman would get a larger pension to recognize the fact she's going to live longer, she's going to need more assets to sustain the income being produced for her. And I know that can be a factor too, but in this situation, I think in both cases, these gentlemen were around the same age. Maybe the spouses were different ages. And that
it would probably be based on the earnings level being different.
And their earnings level was the same too. It's funny, they both started out around the same time, had similar careers, but they, and maybe the best question I should ask is there somewhere where people can go to get the answer? Because the gentleman did try to go to the pension agency responsible, and they handed him a document, and it was rather complicated, and unless he takes it to a lawyer, which he could do, he could have it interpreted, but it's difficult to get an answer. And is there somewhere where the question could be asked and an answer could be given?
We do have individuals, pension plans come to us on specific matters that relate to their own pension plan. Mm-hmm. We couldn't do a comparison with someone else unless we also had that other individual coming to us at the same time.
Okay.
And agreeing to cooperate.
If we were to direct something in writing, giving 2 case scenarios with no names and no personal information, is that something that your office could evaluate and provide some commentary back to us?
We would have to know the formula of the pension plan and a lot of information, but we would certainly look at it.
Okay, I would appreciate that and may endeavor to do that at some future point. I'll try to stick to less technical questions for the remainder. One of the things that I noticed in the annual report for 2009, and I'll read it for the benefit of the other members on the panel here today. This is a summary of some of the current items. One of them is a defined contribution plan committee was established to review current approaches to regulating and supervising defined contribution pension plans, and a terms of reference and work plan for the committee was approved by CAPSA in March 2009. This committee will also establish an industry working group to provide input and advice to the committee. Could you give us an update on that defined contribution plan committee?
Yeah, I'm actually a member of that committee, and we've had a meeting with the industry stakeholder group last June, and we received a tremendous amount of information as a result of that meeting, and we've had several revisions of paper. Our proposal is to meet with the stakeholder group again next month, and we'll make, following that meeting, we'll make some more revisions to our paper, and we'll proceed with recommendations both for industry and for government to consider in the administration of and regulation of pension plans, DC pension plans.
Who was on that committee?
There's representatives from different provinces, as I'm representing Nova Scotia on that committee, and so there's representatives from other jurisdictions as well.
Is it just one representative from our province that's on that committee?
Yes.
And may I ask, would you have experience or background in defined contribution plans?
Yes.
Okay.
Yes, I've had 30 years experience in pensions, so both with an insurance company and with a consulting company, and then with government.
Okay. And the company that you worked for, did it offer defined contribution plans?
Yes.
Okay.
Yeah.
Next question I have relates also to defined contributions plans. There's an element, and actually I'll bring to the attention the pension review panel's final report that was produced in January of 2009. And there was an opportunity that I think was missed in the report, and that was an opportunity for, within these defined contribution or DC plans, for plan sponsors to give their members advice. Have you any thoughts on that?
The problem with giving advice and the great fear of employers is that they would be sued if they gave wrong advice. The recommendations under the capital accumulation plan guidelines that are put out by CAPSA and the industry are for making sure that employees are educated and that they're giving enough information to make appropriate decisions, investment decisions. As far as advice, an employee always has the option of going to someone else for advice, but an advice from an employer on what should be invested is really kind of dangerous territory.
One thing that the report did miss was in the United States, they're looking at putting legislation through called safe harbor legislation. And this will give employers some protection so that if they get somebody in who's qualified to give advice and they give advice to their employees to help them to ensure that they have a good experience with saving and to ensure they have enough assets at the point of their retirement, they want to bring in this safe harbor legislation. That was missed in the report. Has your office ever done any research on that?
Yeah, safe harbor is actually in place in the United States. It's been in place for some time. When CAPSA was looking at the development of the capital accumulation plan guidelines, we looked at whether or not we should introduce safe harbor legislation in Canada. And the conclusion was that safe harbor really wouldn't work with the court system that exists in Canada. With the capital accumulation plan guidelines, the plan administrator establishes the processes and the procedures that needed to make its decisions, and that adherence to those guidelines is actually a very good defense against claims for wrongful action. So that the conclusion was that in Canada we're better off with the guidelines as the defense for the employer to any lawsuit.
I think we're missing an opportunity, and I noticed that that the idea of a safe harbor was really panned in the report. And one thing I would like to point out for the members in the panel, that there are actually 4 large insurance companies in Canada that dominate the defined contribution pension offering, and it would be very difficult for them to provide advice because of the nature of their operations. Do you think that some of their influence and perhaps some of that cultural mindset has influenced the decision on whether or not to look at safe harbors? Because if the United States has looked at it and seen it as a value to people who live there, and we've even talked about it today, the importance of for members to have who are in defined contribution plans to have some advice so that they have some protection, so that they have retirement assets. Do you think that we should take another look at that?
Well, we haven't looked at it thoroughly. I'm not a strong advocate of American legislation. The Americans do not have any locking in requirements in their pension legislation, so the plan members are able to withdraw their funds. And that has led to the, I guess, the small amount of pension assets that are available for people in retirement in the United States. We did look at, as I said, we did look at the safe harbor rules and felt that it really was not appropriate for Canada. We have had good experience to date with the defined contribution plans. As you know, the consolidation of the insurance industry in Canada came over a number of years. We used to have a larger number of insurance providers in Canada, but through amalgamation over the last 15 years, we're down to a much smaller number. However, the financial system in Canada was very robust during the 2008 when the American system had some strong failures. So I do believe that we have a strong system in Canada.
Madam Chair, I would say that if any time there's an opportunity for government to do something that's in the best interests of Nova Scotians who are saving for retirement, I think we should look at those options. And whether it's American legislation or other legislation, I think that if it makes sense to do it, it should at least be looked at. And it's something I plan to look at and present to government in the future, because from my own personal experience, I think it'd be of great value. And while it may be inconvenient for some of the strong players in the industry, I think it would make a difference for people in Nova Scotia who are members of DC plans. The next question I would like to ask is around the unlocking of funds from pensions that are registered in the province. And the federal government has seen fit to allow the unlocking of 50% of pension amounts. And to give an example for members here, you could take, for instance, a university professor. There's a number of universities in Nova Scotia who have these types of plans. And when they retire, they take out a large lump sum. They are prescribed, based on the legislation, to only be allowed to take certain amounts out each year. One of the problems with that, while it does protect them going forward, to ensure they have enough assets to last them over the course of their life, it restricts them if they want to spend more of their money today. And some people feel it's harmfully prescriptive. The federal government has decided to change to allow a 50% unlocking to give members greater flexibility. Why wouldn't we consider doing that in Nova Scotia?
I can't speak for government because government has made some exemptions to legislation, but in my experience over the 30 years that I've been in pensions, locking in is a good thing. On a personal note, when I had left my previous employer with the insurance company, the rules at that time were that you were only vested or locked in if you were age 45 and had 10 years of experience. So I left my first job, although I contributed to pension plan, I only got my own money back, which had been accumulating at 3% interest. Same with my second job, 5.5 years. No vesting, no locking in, only got my own money back. So I had 7.5 years of actual pension plan participation with no pension benefits to show for it. The funds, my own contributions weren't locked in, and I used them to buy a house. So I have 7.5 years of pension plan participation and no pension to show for it. The locking in is the reason we have good pension values for individuals. Pensions are not savings accounts. They are there for society's need to make sure that individuals have assets in retirement when they can no longer work. So
what's interesting, though, is if you have a couple who has one of these locked-in accounts, and if the spouse who had owned the account passes away, the amount that passes on to the spouse immediately is allowed to be unlocked. So I think that it's something we should look at. And it's something that if your spouse dies, you immediately have access, the other spouse has access to it. Why not let them both have access to it before something like that happens? And that's the argument I would put forward.
My argument would be going more the other way, that we should actually impose locking in on the spouse as well. We've got a very old population in Nova Scotia. We have to ensure that people have sufficient funds in retirement. Unlocking, the 50% unlocking done by the federal government and done out west and in Ontario was not done on the basis of any policy analysis to show what is the effect. If we are going to unlock this large amount of funds, what is the impact going to be on our retirement income for our seniors? Nobody has done that study.
Yeah, your time really has elapsed now, Mr. McMaster. Thank you very much. But I think it was an interesting answer that we needed to hear as well. I'd now like to turn for the next 15 minutes to the NDP Caucus, and Mr. McKinnon has the floor.
Thank you very much, Madam Chair. I just want to say what a pleasure it is to have Ms. McNeil-Smith here today, because during the Trenton days, we interacted so often by telephone, and my office sort of became the hardship office, and we had so many cases that we referred to you that I must say your office was swamped. And I congratulate and commend you and thank you as well for the work that you did during those difficult days. So thank you very much.
Thank you.
One question before I revisit the Trenton pension situation. I have constituents that are concerned about the federal legislation in relationship to taxation, where some are allowed to split pension benefits with a spouse and others are not. And I'm just wondering, of the ones that you administer down the road, what percentage of these would be involved in the opportunity to split from a taxation perspective?
I really can't speak to the taxation end at all. I don't administer that legislation. And it was my understanding that it's the choice of individuals as to whether or not they wish to split their pension income, but I wasn't aware of any restrictions.
Well, thank you very much. Revisiting Trenton, there was certainly dismay and disgust with the situation with Greenbrier going bankrupt when one arm was being hived off, Trenton. The company was still viable and operating and reinvesting in Mexico. So the Trenton bill didn't do what it was intended to do in protecting those workers, but that was a province-wide initiative. Has that helped other people in the province, or will it help others in the future?
The requirement for an employer to fund any deficiency and wind-up has helped other groups of employees that were in pension plans. There are big closures like the Moyers chocolate factory in Dartmouth, but also the Maple Leaf plant down in the valley. Both of those plans were topped up by the employers on plan wind-up, and it was because of that particular legislation. So it has proven to be very useful, and I believe it will be more useful in the future.
Thank you very much, because there was the feeling that this bill was brought in for Trenton, but it did have the implications throughout the province.
Yeah. With the structure of companies, of course, each portion of each operation of a company is its own separate entity. And that is done to protect the other companies that are operating under that parent company, to ensure that the whole enterprise doesn't collapse with the collapse of one of the portions of it. And that is quite typical in businesses today. You would rarely see a company that was not specifically related to a specific site.
At the time of the Trenton termination of operation, there were misrepresentations by some segments of the media in relationship to the actual numbers that were affected by the termination of employment there, because we were dealing with over 1,200 employees there, and it sort of went down in 300 increments. And the media of the day, some aspects of the media indicated that 300 were in fact terminated. But over a period of months, it was actually over 1,000 that were terminated. How many hardship cases did you end up with?
Specifically for Trenton, I don't know the number, but I do know that when we had the applications come in for 2009, I believe it was. Just let me look at my figures here. We had a bump, what we call the Trenton Works bump. And that came in let's see now, in January and February. So we had, of 2009, so we went from a normal of say 20 applications per month. We had a slight bump in October to 65 applications in the month of January. So those were the Trenton Works people. So we went from a normal of 28 to 65. So we had 45 more per month coming in as a result of the Trenton Works. We also had another bump this year from applicants with the Moorish Chocolate Factory, and we had a very slight bump of applicants relating to the closure of the plant down in the valley.
Very quick question in relationship to the setup with Anon, I believe was the company. Quebec, a Quebec-based company ended up looking after the pensions and had an administration cost of sort of $250,000 from that. How did that company end up with looking after the pensions?
Yeah. Aon was the consultant all along on the pension plan and was familiar with its operation. So it was chosen to be the administrator on the basis that there wouldn't be any cost associated with them getting up to scratch with respect to how the plan operated or its benefits. Aon spent a considerable amount of time, more than I've seen any administrator wind up, in actually meeting with the employees and talking to them about the level of the benefits available to them. For the most part, most of the Trenton workers only received a pension worth about $30,000. So Aon met with the individuals and said, for those of you who are under age 65, saving this $30,000 is really not going to benefit you because it'll mean that you won't be eligible for old age security. It's not really enough to make a difference. So they worked with all of the employees in making sure that they understood the choices that were available to them, that they could apply for unlocking for financial hardship, making sure that through all steps that they understood as much as they could. So from my perspective, yes, it was expensive, but it's always expensive winding up a pension plan.
Thank you very much, and I had some other questions, but I am going to pass along, and I do think it was well handled, and I think you did a great job as well. Thank you.
Thank you. I do have one comment to make with respect to the Trenton workers. We had expected a second wave of applications from Trenton Works, but because and they haven't come in, and it's my understanding that these people are now fully employed.
Is it Mr. Smith? Yes, okay.
Thank you,
have
Madam Chair.
a few more minutes there until 10:51.
Thank you. I just have a very few questions that I wanted to ask. As I said at the beginning, I'm from Antigonish, a university town, and so the plan at the university is a defined contribution plan, and that would be one presumably that's administered by your office.
Yes.
Now, I wasn't in that kind of a plan myself, so I don't really understand a lot of the nuts and bolts of it, but the employer puts in funds, the university, let's say just a professor puts in funds. I know it goes through all of the university employees, but they put in funds. You had suggested that maybe at like a 10% figure, so if you wanted a $20,000 pension at the end of it because you had all kinds of other money and that's all you wanted, you'd only be concerned about putting away $200,000. Is that, am I onto that?
That's at age 65.
Right.
And that's very, very rough.
Right.
It's just
kind of a rule of thumb.
Guide, yeah.
Right. Similarly, with a defined benefit plan, I had heard that if you could get 70% of your sort of gross income in retirement, you should be able to maintain the same lifestyle. Is that kind of a rule of thumb that you?
The rule of thumb is the goal is 70% of your pre-retirement income from all sources. So you have your Canada pension plan, you've got old age security, you've got your private pension plan, and then you have, you may have income from your own investments. So overall, if you have 70% of your pre-retirement income, you shouldn't experience any drop in income. It's expected that the 70% figure is not necessarily appropriate for all income levels. In some cases, 60% may be enough. Or you may but generally 60 to 70% is appropriate.
I just talking with people in the community, because of the downturn in the economy, a lot of people who might have retired last year or this year coming have decided not to retire because their plans had taken what they called a hit because of their investments. I was never sure who does the investing. Like when the money goes in year after year after year, I presume it's invested every year. Is the employee the one that does that investing?
There are, for defined contribution plans, there's really two types of plans. One is where the one and the most common one is where the employees choose and they choose the investments among the options that have been offered by the employer. So the employer may choose 10 investment funds, and they'll say to their employees in the plan, you can choose to direct your investment among these 10 funds that we have selected. So the younger person may choose to be more heavily invested in equities, where the older person may have some in equities, some in bonds, some in real estate. So that's how it works there. There's also some very large defined contribution plans that are not where the investments are not member directed. The employer manages and invests the whole of the fund, and the employees' contributions, they have units of investment in the pension fund, but it's actually the employer that directs the investments.
Okay.
But those are very unusual. It's mostly member-directed investments.
So when these member-directed ones, which I presume the one at Antigonish is for the university, I'm hearing all the time people are sort of trundling off to see their investment counselors, and it seems to me that it's a real chore to have that responsibility. And I think you said that defined benefit plans have some advantages in terms you don't have to worry about the investment, the promise that you know up front what you're going to get at the end, that kind of thing. In these defined contribution plans, which you say are much more the way things are going now, aren't we losing some advantages because of that?
Well, yes, and you can have two individuals working side by side, contributing the same amount, retiring at the same time, with very different results under member-directed investments, because you may choose to invest conservatively, but it pays off better in the long run, whereas you may have someone else who decides to invest very aggressively, and they may end up gaining or they may end up losing with respect to you. So it would be unusual to have the same result from two very similar people making investments.
Okay. Thank you. I'm going to defer, Madam Chair.
Mr. Goss, you have a couple of minutes.
Sorry.
Mr. Goss.
Thank you.
Thank you.
Thank you, Madam Chair. My question is, the Auditor General wanted your annual report to the Minister to be filed within 6 months of the fiscal year end. Was this done?
Yes, it was. We filed it with the Minister, September 30th.
And the only other question I had, the Auditor General recommended in his report the penalties for late filing of actuarial violations reports. Do any other jurisdictions in the country impose such penalties?
Only one jurisdiction, and that's Quebec, and they've imposed a penalty that's based on the penalty for another filing of an annual return. It's related to the actual size of the pension plan. So we would propose in the next round of changes to the regulations under the Pension Benefits Act that we would impose a penalty, and hopefully that would encourage plan administrators to make sure the reports were filed on time. So we agree with the Auditor General's recommendation. It's just a matter of getting on the regulatory agenda.
Thank you, Madam Chair. My time has expired.
It is absolutely perfect. Thank you very much. And thank you for all the good questions today on this subject. I would like to thank our guest again, Ms. McNeil-Smith. Did you have any final comments for us, just to wrap up, or?
No, I think I think the state of the pension plans in Nova Scotia is relatively good. There are changes that need to be made by administrators to make sure that the plans are sustainable in the long run. And there are certainly changes we can make to our regulations and maybe our legislation that will assist the employers to attain that goal. But certainly we're all working together to improve things where we can.
Well, thank you very much again. And I think one of the messages we heard today is that at this point in time in Canada, there is a lot of attention on pension plans. And, you know, the question that this is an opportunity now for us to turn our attention to it. I know there's been consultation papers and discussion about some of the changes. And I do think that here in the legislature, we need to pay attention and hopefully embrace some of the changes that will ensure sustainability for the system. So thank you very much again. And with that, I'm allowing for a short break here so that the members have a break before we meet again at 11 o'clock for our session on agenda setting, which will be our new method of setting our agenda. So with that, could I have a motion just to adjourn this committee meeting, please? Thank you, Mr. McKinnon. And with that, we'll have a few minutes of break.